In this video, we're talking about liquidity pools. Specifically, we'll answer questions such as what a liquidity pool is, how it works, and why such a concept is useful, in the first place. Let's not waste any time and get right to it. What is a liquidity pool? There are two ways of how you can look at it, as an investor, and as someone who will actually use the pool. First, let's discuss the investor's point of view. A liquidity pool is a place where you can lock up your money or a specific asset, for a set amount of time. If you do so, you'll be called a liquidity provider. Imagine that you and your friend decide to throw your $100 bills into a pot for a week. After a week, you need that money for a new shoe. Well, liquidity pools allow you to take your money out, usually without any problems, and at any point in time. Liquidity pools allow your money to work for you. After a week, you might come to find that your $100 has now turned into $110. Now, obviously, this is just an example, and the rate at which you will earn the passive interest will vary from pool to pool, but you get the general idea, nonetheless. Now, you do need to know that you can provide other crypto assets to the liquidity pool, and not only fiat money. It all depends on the pool. For example, some liquidity pools might allow you to earn interest on Bitcoin, Ethereum, and other super popular cryptocurrencies. From a liquidity provider's point of view, that's the general idea of how a liquidity pool works. It's rather simple. On the surface level, you put money in, hoping that, in some time, you'll take out a bit more. Moving on, in order to understand the use cases of liquidity pools from the user side of the table, we need to take a look at how these pools work, in the first place. How do liquidity pools work? Liquidity pools allow decentralized exchanges to function, in the first place. When you come to trade on a decentralized exchange, and want to, say, sell your tokens, liquidity pools allow you to do so. They hold some of those tokens inside of themselves, and pay out the crypto that you want for the tokens. The liquidity pool is filled with a bunch of funds provided by liquidity providers. When you're buying or selling your desired coin on a liquidity pool, there is no seller or buyer on the other side. Instead, you always trade with the pool itself. All your and pool activities are governed by the automated algorithm in a smart contract. Prices of our trades are also managed by this algorithm, based on the current and historical trades that happened in that pool. So, no humans are needed on the other side, to make the trade happen, because everything that happens is between you and a programmed algorithm that is launched on a blockchain, and can't be changed. Liquidity pools hold two or more assets, cryptocurrencies, USD, and so on, inside of them, and allow people to trade on decentralized exchange platforms. In turn, while individuals use the pools for their trades, investors will receive interest on their investments, over time. Simple. Why are liquidity pools useful? Why anyone would want to use these pools in the first place? Imagine that you're trading on a centralized, well-known cryptocurrency exchange. Suddenly, the price of Bitcoin drops by 40%, out of the blue. What do you think happens next? If you said panic, you're definitely correct. Fearing further price plunges, thousands of traders and their pets rush to the exchange, in order to sell their BTC. While all of this is happening, the CEO of the exchange sees that the situation is dire. They are running out of fiat money, and their servers are crashing. The CEO decides to freeze the transactions. In other words, you are no longer able to sell your BTC on the exchange. Just to be clear, the managing staff of a centralized exchange is always prepared to pull the kill switch, and to turn off our trading party if a situation starts moving away from their interests. This is exactly why decentralized exchanges are popular and useful. No one can dictate what happens with a decentralized exchange simply because he got out of bed on the wrong foot that morning. And liquidity pools allow these decentralized exchanges to remain decentralized, in the first place. On top of that, if the aforementioned CEO freezes the operations of their exchange, as discussed earlier, this will impact the price further. People will start panicking even more. On a decentralized exchange, liquidity pools are the ones that dictate the price of an asset. They are not impacted by bad mood or weather. Sure, the price will follow the market, but it will be less prone to various forms of manipulation. Once again, this is thanks to the logic behind liquidity pool development. Another use for liquidity pools among traders is arbitrage trading. Traders try to search for many liquidity pools with the best prices of an asset lying within, and then buy that asset, so that they could trade it on a centralized or even other decentralized exchanges, and make a profit with the difference in doing so. Let's imagine a trader finds the decentralized exchange that currently trades some coin or token for $50 per coin. After buying these tokens, he goes to a different exchange with a higher bid price for the same coin, and sells it there for $51 per coin. By doing so, his profit is $1 per coin, and this is huge. Arbitrage trading requires a lot of experience and discipline, but it's one of the more common uses for liquidity pools, nonetheless. It's made possible due to the common asset price differences between centralized exchanges and liquidity pools. There's a lot more when it comes to liquidity pools, but the information discussed in this video should serve as a great starting point for beginners. I hope you found it interesting. Thanks for watching, and stay tuned for more.